Hello everyone and welcome to this Demica webinar, Demica Insight Q2 2023, Meeting the Demand. Before we get into the webinar proper, I'd like to go over a few housekeeping points so you know how to participate in today's event. Firstly, you're using your computer audio to listen to the webinar. You're in listen-only mode. However, we would really appreciate your participation via asking questions of our speakers using your question pane of your control panel. You can ask questions anytime through the webinar and we'll look to address those as those come in. Finally, the webinar is being recorded and anyone who registered for the session should expect to receive the recording within 24 to 48 hours of the session. Thanks once again for joining, and with that, I'm really pleased to hand over to Maurice Benisty, Demica's Chief Commercial Officer, to begin the webinar proper.
Thanks a lot, Dan. Good to be back on the Insight series and to kick off. So you've got a flavor of the agenda that we've got in front of us here. So we're going to be talking about what platform data we've seen, what trends it indicates, and how that impacts the market, broadly speaking, over the next 45 minutes or so. So if we can move on to the next slide. So just to introduce the speakers, I'll introduce myself. I think most of you know about Demica and have heard from me before. Adam is our head of distribution, so leads our engagement with the market and has some really great insights to share. And I'll ask Paula, who's joining us from Squire Patton Boggs, to tell us a little bit more about herself and the firm.
Good afternoon, everyone. Paula Laird, partner at Squire Patton Boggs and head of banking for Europe and the Middle East. Squire Patton Boggs is a global law firm, and I've been involved in the asset-based lending sector and invoice finance sector, receivables finance, for 20+ years, which I've seen a considerable development in the sector during that time, which we will discuss as we get into the briefing.
Great, and good to have you, Paula. Let's move on, Dan. So just to remind you of the data set, so the Demica platform supports assets of around 27-30 billion of receivables, and that implies turnover of around 150+ billion. And what we do is we narrow that down to a representative sector, so we take out any concentrations, and that gives us a reasonably broad spread of a view across different industry segments. And if we move on to the next page, I'm just going to pull out a couple of sectors where we've been reflecting on what the second quarter data is starting to tell us. So on transportation and logistics, and this is predominantly ground transportation, kind of B2B in North America and in Europe, you can see a significant kind of deviation from the trend that we saw in 2022 and even 2021. Interestingly, though, I remember when we were doing this about a year ago, and the trend looked much stronger. The share price index of maybe 4 or 5 of companies kind of comparable in this space, the kind of large ones that be familiar to all of you, were off 20-30%. So clearly anticipating that things would get worse. They have, and if you look at share price performance, if that's an indication of what's coming, it's been broadly positive over the course of this year. And that's something we're going to reflect on as to, kind of whether the doom and misery that we were all forecasting has come about, is going to get worse, is going to get better. So an interesting data point. Move on to the next one, Dan. So paper and packaging, again, off a little bit relative to last year, where you really were seeing a strong recovery. Maybe we're back to business as normal, but broadly speaking, kind of performance is flat and above 21. So not a huge amount. That I think doesn't tell us a huge amount of what's coming, but we are seeing the impact of mix changes continue. So paper and packaging stronger, paper weaker, and so as the supply chain adapts to different demand patterns, the kind of sector adapts, and you've seen that kind of flatter in the first half of this year than prior. If you go to the final one, kind of food and food production, and this is food into supermarkets, food distribution. And here you can see the increase in terms of absolute prices. And we think this is kind of reflective on what our customers are telling us, the impact of inflation and cost of living. So not necessarily good news for the industry as costs are passed through, but an indication of inflation. And so that's what the data is telling us. And I think, you know, perhaps as interestingly, it'd be interesting, Paula, to hear whether some of those trends, right, an unpredictable economic environment, the impact of kind of rate increases to offset inflation, what you're hearing from your clients and what you're seeing in terms of deal activity in the working capital space, you know, whether that resonates with you, and just be interested in your perspective.
Yes, I mean, it certainly does resonate with me, and I think with all the lenders that I discuss the market with, which I think is a very frequent conversation these days. You either talk about the weather or you talk about the state of the markets and the economy. So I think we were all coming off, you know, a very, very busy period over the last 3 years post-pandemic, as companies needed to put financing in place, as private equity had a huge amount of dry powder to deploy. So we saw so much more M&A activity in those 2 to 3 years than perhaps we've seen in the previous 10. The market has definitely slowed this year, and we've certainly had, you know, a lot of headwinds facing companies which were less predictable last year. I don't think anybody thought that inflation would get to the level that it's got to, that interest rates would have to rise so quickly. So there's definitely been a softening in activity. But I think, you know, there's a bifurcation, isn't there, in the market? Well-managed, well-capitalized businesses will always be able to get funding, and we're seeing that continue. I think, you know, the mid-market perhaps is finding conditions more challenging, depending on the sector that it's in. But lots of reasons to be positive, I think. Certainly, the first half of the year was slower, but we're seeing activity tick up, and it's anecdotal, isn't it? Because you always sense the busyness of the market compared to how busy, you know, you and your team are. But I speak for the whole of Europe and the Middle East in judging deal activity, and that's still quite significant. Actually, we're still seeing financings getting done, having to get done, because obviously, you know, liquidity is a challenge for many companies. I think what we're seeing though is just a difference in the volume of lending in different sectors. So leverage has been, you know, more challenging during the course of this year, but we are seeing a tick up in asset-based lending and receivables finance, and that, I think, trajectory will continue as we move through the credit cycle.
Yeah, no, I mean, certainly the focus on the product from sub-investment grade companies is increased, right? Our inbound inquiry has increased. The amount we've been putting out into market has really taken off in the past 6 months. Adam, you know, interested in, obviously you're at the front end of this, interested in what you're seeing from different investor types.
Yeah, I think that point, Maurice, that you just made is a really good one. In this more challenging part of the macro cycle that we're currently in, if you like, and looking to come out the other side of, lots of companies are looking at different sources of liquidity. And one of the advantages of financing based on receivables or invoices is that you can often look to raise that financing based on the credit quality, not of your own business, but of that, of course, of your customers. And that high quality pool of collateral can lead to opportunities where more generalist financing might not be so readily available. So I think that's one of the points that we've seen in our origination flow, Maurice, is a lot of, as you said, sub-investment grade businesses looking to tap into their best assets, if you like, to raise financing. In terms of lender appetite, I think there's 2 themes that I would highlight. If I think about the banks that we talk to and their lending activity, they're certainly incredibly busy, both supporting businesses who are upsizing or renewing financings, or as I mentioned just now, supporting newer lenders, and certainly the capital markets teams at banks that undertake securitization transactions are seeing an awful lot of deal flow right now. On the non-bank side, that's typically investors looking to focus on perhaps transactions with a bit more risk, a bit more yield associated with them. There's a number of them really growing their platforms very successfully, perhaps being a bit more picky and choosy in terms of the transactions that they look to finance, or adjusting their pricing to reflect that slightly negative macro perspective. But demand is high, and we have a lot of new entrants entering this business. I'll maybe talk to some examples of that a little later on in the webinar. But buoyant levels of activity and growth for both bank and non-bank funders.
And it's been interesting to see how, if you contrast the leverage loan markets to the securitization or broader asset-backed lending markets, because it's not a liquid market, you've not seen the same level of price dislocation, I think it's fair to say.
Absolutely. I'd highlight a couple of things there. So if we look at banks, they're really driven by their capital models and by their own cost of funding in terms of the pricing they put on transactions, much less need to pay attention or to focus in on where other parts of the capital markets are pricing different types of credit risk. And so their pricing for good quality transactions has remained resilient, albeit affected a little bit by the increase across the board that banks have seen in their cost of funds for sure. And then the other point, as I was making earlier, is if you can focus the credit risk and the lending opportunity on the quality of the receivables through certain structural features that allow you to do so, that allows a borrower to really hone in on achieving pricing far more attractive than they can obtain in the more general markets because of that quality of their collateral.
And Paula, when we think about kind of working capital finance and the distinction between asset-backed finance and then kind of receivables discount, which implies the true sale, what are you seeing in terms of kind of interest across both and the evolution of both markets? And I guess a subsidiary question, what we're seeing a lot of companies being able to do, again, on the sub-investment grade side, is they've got much looser loan documentation to be able to work within. You go back a number of years and this collateral was pledged to someone, right? Typically the senior lenders. Now there's a lot more room to maneuver. You think that's reshaping the market in different ways?
Yes, I mean, I think there's been sort of exponential growth in the use of the product. If you look at some of the stats, the pre-financial crisis and post-financial crisis, they indicate that this market's grown by about 67%. It's much bigger in the US, and it's still not as well understood in the UK and Europe as it is in the US. But nevertheless, it's becoming better received, better understood, better, not a lender of last resort, as perhaps was the perception pre-financial crisis, and it struggled, I think, with its image for a long time. But you know, I now see the sort of receivables invoice discounting supply chain solution meeting the securitization market and perhaps being a bit more flexible. And Adam mentioned the pricing advantages that it confers. And we're seeing deals which are sort of touching 350, you know, $500 million, which are not done through the public markets. They're done through the private markets, perhaps with a club of direct lenders. And that's a very flexible solution for companies, because you can lend, you know, as one transaction we've been involved in recently was a global transaction across APAC, the US and Europe, without having necessarily the expense of a securitization or the complexity of putting that into place, but using the same types of techniques, such as the use of an SPV, because that becomes very important. I think that's, you know, the challenge and the drawback to funding just generally on a cross-border basis, that you have to tread around the regulatory regimes in each country. We don't have that sort of harmonization even within Europe yet. But nevertheless, this technique, because you can separate it from the assets of the company, put the assets into an SPV, which again, you know, Demica are sort of very well versed in putting those structures together. And another area where companies are finding it useful is if they're tapping into either a securitization or a larger working capital structured finance solution, they might use that funding for a period and then go towards supply chain finance when that becomes available, because that's a cheaper source of funding. So you are seeing a lot of sort of mixing and matching of different finance techniques, which
and those SPV structures, are you seeing, because receivables well documented, kind of well practiced, we heard a lot of promotion, if you will, of inventory finance. Are you starting to see that translate into actual deal flow with off-balance sheet structures being deployed by companies for inventory finance? And if so, interested in what you're seeing.
Yeah, I mean, off-balance sheet structures for inventory finance are interesting in that, in the UK environment, we've had the introduction of Crown Preference, which challenges the liquidity you can get out of a borrowing base in relation to inventory. So SPV structures are looked at in that context, or any sort of title financing in Europe is looked at that transfer to an SPV in order to raise debt, because again, you've got different things to consider in Europe in relation to licensing, in relation to taking valid security. So an SPV structure is always something you would look at. I think what I would say in relation to that is that you need to just be aware of how far you are prepared to go in order to introduce additional liquidity into the structure. If you can get sufficient liquidity from taking security against inventory, and a more innovative structure would give you an additional 20% against the value of those assets, you need to consider whether it's really worthwhile, because they can be quite intricate and involved to set up. So I wouldn't say those structures have become commoditized yet by any means. I'm sure that will evolve in time, but at the moment I think they tend to be done more on a one-off basis in relation to inventory, whereas in relation to receivables they're very well established.
Yeah, no, I mean, we're seeing the funders that we're seeing active are kind of pursuing more the investment grade companies who are looking for more flexibility within the supply chain, so the ability to reduce the levels of inventory on their balance sheet and find more flexible ways of managing it. I mean, Adam, those are the kinds of deals that those funders call us to try and originate, rather than crossing over into sub-investment grade, where, as you say, it becomes more challenging to do that, because the ultimate...
I think that's true unless the inventory is very liquid, and then you're not relying on the corporate covenant, but more on the ability to liquidate the collateral, the inventory, if you like, in a straightforward way. I wanted to come back, Maurice, a little bit to that point about ABL versus true sale style financing, because one of the areas that we focus on, and that's become a sector, become a growing user of receivables finance, of course, is financial sponsors. And often they put together a capital structure when they bought the company, if you like, which involves securing much of the assets, if you like, of the business in order to raise debt in the most efficient way. But many of them, of course, well, not of course, but many of them do have an ability to still sell some of their receivables. There may be a specific allowance within the loan documentation, or it may be unfettered. And that's certainly what we found is that's what's creating demand from financial sponsor-owned businesses in the US, where of course an ABL isn't relevant. They've already done their senior secured funding, but creating extra liquidity through an authorized use of the receivables for financing has been a trend. And certainly the non-bank lenders that we talk to in the US markets are very much looking to play into that opportunity by financing those receivables for those sponsor-owned businesses. And it's notable that a large number now of the very largest, most of our key name private credit lenders, names that be familiar to many people on this call, have now set up separate businesses just to finance transactions in this way. And I think watch this space. I think they'll be more and more active in the US market in doing that. Now in Europe, where ABL is often less well developed and so on, you've got a different dynamic. But I think it's worth highlighting that's what's part of a trend, and certainly the mandates that Demica has been winning this year have reflected that with our North American sponsor clients.
I think that's a really, really interesting point, Adam, because companies should always be looking at sort of maximum flexibility. And I've been working with one borrower client that's got sort of a debt requirement of £500 million, and it's structured it through different inventory and receivables deals. But what you typically see is a senior facility, especially for a company that size, which has got lots and lots of restrictions, and sponsors have been, you know, very aggressive in making sure that those baskets are available. But we've found perhaps less knowledge on the corporate side. When you've got a sponsor-backed business, I think that's very easy to achieve because the sponsor has a lot of negotiating power with the lenders. But I think in the context of a corporate, they may not often know that, you know, they might need another source of liquidity, and receivables is a really good basket to have available, you know, a certain level of basket where they can dispose of receivables, because with a senior facility particularly, it's sort of, you know, the large cap size, that they can have, you know, a sort of very, very restrictive baskets if they haven't negotiated them, but still a lot of receivables that could be disposed of outside of those baskets if they're negotiated properly.
Yeah, no, I mean, the other area where we've closed a couple of transactions has been in the kind of embedded finance space, where we've seen companies that are building receivables on their balance sheet as a result of the transactions that their platforms will support, being funded through an ABL. And of course, where you have an ABL that is only funding receivables, the switch to you know, receivables discounting, factoring, securitization structure is much easier to accomplish because you don't need to compensate for the capacity that you lose through the other assets. And that gives the issue of the benefit of balance sheet treatment, a kind of more asset-like profile. I mean, there's been a lot talked about with regard to embedded finance. We have, as I said, we've closed a couple of deals, so it's more than talk for us. But you know, Paula, are there businesses within your network that you're seeing kind of get live to that and rethinking the way they finance their portfolios, or is, you know, is more traditional kind of industries and industry segments where you've been active?
No, I think it's definitely, you know, evolved really into all sectors. I think, you know, construction is still probably very, very difficult because of the sort of, you know, the part payments, and perhaps that's because the lenders in the space are not as comfortable with set-off provisions and so on. So, you know, there will always be an element of due diligence according to sector, but I think we're relatively sector agnostic. The product itself lends itself to those industries where, you know, you've got assets. If you're doing that's obviously, you know, goes without saying, where you've got more assets on the balance sheet and you're trying to leverage those as against the future cash flows of the business, then obviously the product's going to be more suitable. It's not suitable for some industries, but, you know, most industries will have a book of receivables, and that can be financed against. So, you know, regardless of whether it's tech or life sciences or so on, if they're a supplier, they're supplying products. And we've certainly seen a growth across all industries, and also much more sponsor engagement with the product as well. I can remember a time where it just wasn't, you know, an option. I think sponsors were skeptical about the fact that you could raise sufficient liquidity. And I think that comes down to the quality of the information that is provided at the outset by both the company, perhaps the debt advisor, and the sponsor in conjunction. I think if the sorts of information that you've got at your fingertips, because you're running the data, you know, the debtor days, things like that, and understanding what an asset-based lender actually looks at and what information is important to them. They quite often get presented with a set of financials, accounts, which don't really give them the information. So I think where the growth of this industry is restricted is because if you've got a tight timeline or it's event driven, there's perhaps an acquisition involved with it, then sponsors and debt advisors will be a bit more skeptical. But I think when it's actually put in place, it's, you know, and it's well run, I think you know, that is not a bar at all, and there is no execution risk associated with it.
And I think that there's an awful lot that can be done to improve that process, which then drives growth, right? What we spend a lot of time with our clients is giving them the checklist that they need, giving them the historic data that they need to generate, and then tying it back to how that gets them a better deal. And it's not necessarily intuitive to them. And I point out when they say, well, this is a lot of work, right? You know, when you're asking me for all this kind of debtor book performance and the like, I'm like, well, it's not as much work as preparing a due diligence report, right? A financial due diligence report, or a market due diligence report that sort of supports a leveraged facility. And so, you know, certainly one of our big pushes to try and drive adoption is to do the prep work. And if you do it well and you know what you're doing, whether you're a sponsor or corporate treasurer, the data should be readily easily, you know, reasonably easy to access. It's just about putting the resource on ahead of getting the quote. And I know, Adam, you know, I come to you asking for pricing quotes and indications ahead of doing my homework. You quite rightly put me in my place. But I mean, in terms of what investors are looking for and the level of sophistication and the breadth of investor base that will consider these structures, be interested in your perspective, particularly as it relates to non-bank financial institutions, because that's been a long time coming, and it does feel like there's a bit of momentum now.
Yeah, I mean, two parts to your question, I guess, Maurice. You know, we certainly have a standardized approach that we use in presenting opportunities to funders, which involves both allowing them to understand the business and financial performance of the borrower, as well as the story, if you like, around the receivables, how they perform, who the debtors are, and so on, that we then complement with the inevitable specific questions that different funders have about a business and about the order to cash process, if you like, that these companies go through. I guess what we've learned with the increasing number of transactions that we go to market with is that, you know, no two funders are the same in terms of the things that are important to them, that drive their appetite and decisions. But I'll highlight a couple of themes. I think we have a number of funders, particularly in the banking sector, for whom relationship can be a very important point. But equally, amongst banks and certainly the non-banks, they're willing to consider the transaction on its own merits rather than the context of broader relationship dialogue with a particular borrower. If we now go on to think about those non-bank investors that you mentioned, you know, they really range all the way from what I'll call household name institutional asset managers who have either a dedicated team or part of their private credit investing activity that seeks to look at working capital financing. That's certainly true in Europe, through to specialist asset managers who built businesses around trying to provide working capital financing. And a number of those perhaps are embedded in larger groups or standalone businesses and are growing really successfully. And they're in the middle part of the risk spectrum in terms of the things that they want to do. And then we have the private credit lending universe. Now, there's been a lot of press coverage about this investor base and the growth of assets deployed in the private credit world. On all of the larger names that feature relatively regularly in the press have some degree of presence in this market. And in a number of cases, as I mentioned earlier, building branded businesses with specific origination appetites and capabilities. Now, I describe most of these lenders as seeking to ideally operate across Europe and North America as their first jurisdictions that they're most interested in, but increasingly spreading out around the world and able to take a look at receivables in really quite a wide range of places. And as I mentioned, because relationship is not their driver, it's really about looking at the transaction opportunity. You can tap into what are really powerful diversifying sources of financing if you're a corporate from the relationship banks that you're used to dealing with. In terms of pricing, those non-bank lenders in some cases can absolutely compete with banks for certain types of transactions, but they can also handle much more risky transactions for companies perhaps rated as low as the bottom end of sub-investment grade, perhaps companies going through some form of restructuring. And now we're also seeing a trend reflected in some mandates that we have to work in M&A related situations, to use receivables financing as a really efficient way to post-completion finance a big chunk of the acquisition cost that they're going through. So I'm telling a story about really quite a lot of flexibility there. You know, at Demica, we speak to over 200 different lenders across the banks and non-banks, and it would be too simplistic to say we've got something for everybody, but we've certainly got lenders and investors willing to consider a really wide range of opportunities.
Yeah, no, and it's fascinating to see the contrast between different segments of the market, because our bank customers, our platform customers, predominantly focused on investment grade and crossover investment grade, and there the usage much more driven towards trade finance, right? And looking at underlying flows, and the considerations are very different. One region, Paula, that you referenced was the Middle East, and it's been interesting over the the 6 years that I've been at Demica. I remember when I first arrived, we were starting to see inbound interest from Middle Eastern banks on open account trade finance. It was mainly on the platform side of the business, which was new, and it really has gathered momentum. And if you map onto that the very positive economic environment that exists in in the Gulf countries in particular, there seems to be a real kind of organic growth story taking place that are meeting some of the requirements, particularly of the oil and gas industry. What are you seeing there? Is that an active area within your franchise? Would be interested in some color around that.
Yes, it is, and also we're noticing a lot of non-bank financial institutions who are increasingly asking us about the area, how to structure receivables financing in the Middle East. So yes, I mean it is a growth area. I think it's an area which that the legal market is perhaps not as advanced in terms of commoditizing things, because I think there is still quite slow processes. We took security over shares recently, and it was quite a protracted process because it has to be registered in a sort of in a public institution, and that causes delays, causes frustration on the part of the client, who had to keep requesting the bank for a waiver in order to get it in place. So it's a bit of a clunky process is how I'd describe it. So although the requirement for the financing is exploding, perhaps the legal framework hasn't kept up to the same extent. I'm sure that will change, but.
And I think for asset-backed lending, I'm sure that's true. My question was more around receivables discounting, and whether you're seeing you're seeing increased flows there, because it is in some ways a simpler product to operationalize. I suspect it's still with better rated companies, but there's a lot of growth that we're seeing there. And I guess the investor group we haven't talked about, when again focusing on working capital and AR, are the factors. So the factoring firms in Europe, to me, are, they kind of stand very much independently from other funding sources, particularly when you contrast the European to the US market, and you see them grow much broader out of Europe. And I think, as someone said, giving securitization in many ways a run for their money. I'd be interested in what you both see. Maybe we'll start with you, Adam, in terms of how they're growing out of their markets and into new jurisdictions, and how flexible we're starting to see them become.
Yeah, it's a really good point, Maurice. So people may be aware that many of the very large factoring groups that exist in Europe are often connected with broader banking groups. So, but they're often very much standalone subsidiaries. And so, if you've tapped into or spoke to a specific bank around financing, it would be wrong to assume that the factoring house that may be part of the same group will adopt the same approach to its parent. They often act very independently. They're not relationship driven in most cases, and able to really competitively price transactions for those borrowers for whom the product suits. And I think that's a really important point. They very much want to factor all of the receivables. In other words, purchase all of the receivables of a given borrower. That's a very common feature. There's quite an extensive audit process that takes place to support the financing, but they can be very competitive. We've got great systems, if you like, to support the business that they do. It's a real contrast to the business as it's perceived today in the US market, where factoring tends to be focused on smaller borrowers, tends to be a much higher pricing, and to be a product not so often used by the larger corporates in the US. So two very distinct and different markets. But you're absolutely right, Maurice. They give securitization a run for its money in terms of price competitiveness and in terms of advance rate in certain circumstances. But there are certain nuances to the different ways that factors approach this market, which means that making sure you've understood all aspects of the way what's often quite a complex term sheet will work is a very important part of the journey for any borrower.
And I think it's that suitability, right? There are some transactions that we see that could be serviced by the factoring market, but are kind of clearly better served through a securitization vehicle. And you see it vice versa. And the more visibility there is in the mind of a corporate treasurer or a private equity firm to those as options, the more scope there is to grow the market. And I think that's where it's less in the competition than in what market, what you can do for market growth by having greater of those products.
Indeed, you made a point I didn't cover, Maurice, about geography. This is a set of lenders that are really focused on what I'll call core Northern European markets historically, but very much more flexible now. We have a transaction with a factoring house focused on a Spanish business. We have another transaction focused on a North American business where the appetite to provide dollar financing is now a key part of the product armory of some of these factoring houses. So you're right, they are becoming more flexible in terms of the range of jurisdictions that they can consider.
I think there's a regulatory inhibitor as well to factoring companies taking the place of securitization generally, because there are caveats around Europe. There are ways in which you can establish an SPV without necessarily being caught by the licensing regulations, whereas to your question, Maurice, can factoring companies expand out of their jurisdiction? Yes and no. They can if they're a bank that's got a good broad footprint in Europe, and there are some banks that fall into that category, but there are others that are just country specific and would find it difficult to expand beyond their specific jurisdiction, which is where I think securitization will always be a useful tool, because you can step outside of those regulatory restrictions.
And I guess I'd ask our audience to prompt some questions as we draw to a close. I guess another theme that we talked a lot about within the industry over the course of the past 12 months has been ESG, and a couple of stories from my side. The first was we ran a placement exercise on for an oil refinery and found real barriers to investor appetite on the basis of its profile within the oil and gas industry. We did find a funder for that transaction, but we are seeing banks pull back on their industry limits in some cases, but equally we're seeing some banks step forward. That came out of our benchmark report. So it's a mix, as you had last year, a very strong reaction or movement to promote ESG and to ensure it's embedded in all all funding policies, which I think is the case for all banks. But you've had this year a more nuanced approach. Equally, we've seen a real divergence or a real benefit in terms of investor appetite for ESG friendly businesses. So maybe Adam, you can talk about that, because I think you're the sharp end of both of those examples.
Yeah, I mean, we've been working on a transaction very recently with your team, Maurice, as you know, on a business that's got some very strong ESG credentials around a big component of its manufacturing activity, and actually had already utilized this to access some preferential bank financing, associated performance against certain KPIs, and that's now something which is being offered to our client by the lending banks in relation to a financing proposal that's currently under consideration. So creating triggers that are observable and measurable and linking the financing margin to that is one example that's very recent. We also publicized a transaction last year that we worked on supporting a business called Barrett, which is one of the world's largest chocolate producers, and the IFC part of the World Bank is supporting a payables program linked to the importation of cocoa from a variety of the world's jurisdictions where that product is grown. So we've certainly seen transactions and linked it into to pricing, which I think is a very positive trend and one that we'll only see continue. Just to briefly touch on that the first example you gave, there are certain sectors that are really hard to finance. I think coal would be an obvious one to absolutely call out there, where unsurprisingly there are a very limited number of funders interested in financing transactions linked to coal. And oil and gas is on the cusp of that, where there's groups of funders who've signed up to certain international accords, if you like, that mean that they aren't looking to finance new activity in that sector, and it is making it harder for organisations in this space to fund themselves efficiently, and they need to be creative to continue to do that. So lots of discussion around this, and many lenders' positions are changing as time evolves.
Paula, you seeing any actual deal examples where this is kind of coming into flight?
Yes, we are, and I think it's really an important consideration for any finance director to be looking at, KPIs. It's really starting to feed into the legal documentation, and interest rates will be linked in order to performance against those KPIs. So I wouldn't say it's in every document at the moment, but we're certainly seeing an increasing number, and a lot of the banks are coming out and saying, that their policy is to do green loans, and they're taking this sector very seriously. In relation to oil and gas, I think that's an interesting observation, and I agree it is harder to get funding in that sector, but nevertheless it will still be an important part of what fuels our economy for the foreseeable future. So there are still lenders that are able to lend. I think companies in that sector are probably increasingly having to look to direct lenders rather than the traditional forms of finance. So that again is changing, but it's certainly, I don't think it's quite in the same category as coal yet, and we're certainly seeing quite a few financings in that sector.
Yeah, and I think some banks are decreasing, but some banks are increasing, notably. We got a question in. I guess this is one for you, Adam. On the investor/lender side, do you see the non-bank financial institutions able to explore a broader range of transactions due to lighter regulatory oversight, or is there very little difference on what both types of institutions could do? But question for both of you. Maybe we'll start with Adam.
Yeah, so I think there's two components to the answer to that question. It's true that non-bank lenders aren't governed by regulatory capital rules in the way that regulated financial institutions are. So they will tend to consider and price transactions based on their true economic perception of the riskiness of a given deal, rather than driven by the amount of capital that they're required to hold against the transaction by their regulator. And that can both create flexibility on one side, but also can mean that they will more closely relate the pricing they provide to what I'll call observable market variables, rather than internal models to derive pricing. So I think it does make a difference from that perspective. Additionally, some of those lenders where their activity is less visible can certainly adopt more flexibility around jurisdiction, around what a borrower can be, and indeed around those ESG points that you were just alluding to. So, I think the expectation many borrowers might have that a non-bank lender is more expensive than a bank will often be true if you're able to compare like with like, but they're often looking to fill a space that bank lenders are less excited to operate in, and they may often explicitly ask me that question, why is this a deal a bank couldn't do? Because a bank is a proxy for a more competitive, although perhaps more rigidly structured transaction.
And on the non-bank side, so if we think about the private credit universe that as you referenced, you've got the likes of Apollo, Blackstone building their own branded businesses, sort of serving the space. If you had to guess at the level of capital that had been deployed by that market now, where would you put that? Where would you put that range, Adam?
It's a really good question. It depends what we put into the universe of those non-bank lenders. If we think about a combination of institutional asset managers, specialist asset managers, and the private credit lenders, I would put volumes across the investors that we speak to today somewhere between 20 and 30 billion dollars. You've then got to add into that the factoring houses, I guess, which we call a non-bank lending group, which can be, which are a significant incremental component of that. But those, the big asset managers, the specialist investors and brokers, I'd say 20 to 30 billion today. So still much smaller, clearly, than the number in bank balance sheets.
Yeah, but exponentially larger than when it was, when we started out on this journey kind of 5-6 years ago.
Indeed, without naming names, we've got two non-bank lenders that we're engaged with, both of whom have somewhere between $2 and $3 billion each of assets in this space that they manage. And then I've got another couple in my mind in the sort of 750 to $1 billion number, and then obviously on from there. So you've got some now quite significant players willing to really be quite flexible and do even modestly sized transactions as part of the growth in their AUM.
Paula, those numbers resonate with you?
Yeah, they definitely do. One stat I saw actually was that direct lenders constitute about 72% of the market now, which is astonishing considering when you look back to pre-financial crisis and the exponential growth. But one thing we are seeing actually in relation to the role of the banks is combination of a bank and direct lenders. So you alluded to the fact, which I completely agree with Adam, that direct lenders will be a bit more jurisdiction agnostic, whereas the traditional lenders will perhaps avoid certain jurisdictions. So we sometimes see deals where a direct lender will get together with a bank and they will just bifurcate the deal between them. And also in the asset-based lending space, where perhaps the direct lender will take a second out piece in order to get more debt into the deal. So I think that combination of lenders sort of across the capital structure is really growing as well.
Yeah, and I think in the asset-backed lending and leverage loan market, it's shifted, right? I mean, when I started out more years ago than I'll admit on this webinar, it was 10% non-bank and 90% bank. It feels that if you look at receivables discounting, working capital, so more off-balance sheet receivables purchase type solutions, it's at that very early stage. I would say it's not even 99.1 or 90. It's they have sub 5% of the market, but it's growing so quickly. It won't surprise me.
I'd make an interesting point, referencing a statistic that Paula just quoted. So that 72% number for non-bank lenders will be in the leverage loan market, which has evolved now as a large number of players who run funds or specialist vehicles look to acquire large volumes of leverage loans. And it would be foolish to say that's what the working capital financing market will be tomorrow. But as more non-bank lenders learn the tools, techniques, the structuring skills to get these deals done, as they have done in leverage loans, then you can absolutely see them playing a more and more important part. I think that's only going to be boosted by ongoing changes to the regulatory capital environment, which make very short-dated lending product, which working capital typically is, a little less attractive for banks going forward than it's been in the past. So I think there's a number of factors and a lesson to be learned from another market that's gone completely in that direction.
Yeah. Great. Well, look, I think we can wrap now. Give people a little bit of time back in their day. But Paula, thank you very much for joining us. Adam, always a pleasure. And with that, we'll wrap our Insight webinar for Q2. And thanks, Dan, for putting it all together.
Thank you.
Thanks
very much.